Hi all, thank you very much for joining us today on the session of how to beat your competition in P&C with a distribution-free approach and pricing optimization. I am Oana Avramescu, the SaaS Global Lead for SaaS Dynamic Actuarial Modeling, and I help insurers how to best improve their risk measurements, increase their market share, and assure the regulatory compliance. Today with me, Claudio Senatore, who is a distinguished actuary and insurance solution leader, will show you and will share with you how the distribution-free approach technique can provide accurate insight into the pricing methodology in P&C. Claudio, the floor is yours.
Hello everyone. So let me change to the relative slide. So let's start from the actual benchmark in the market. So actuaries are striving to create more accurate and fair pricing models. And we would like to draw your attention to an underutilized but powerful method. So that is the quantile regression. To begin, let's briefly review the traditional GLM and GAM approaches. So GLMs are a natural extension of linear regression, allowing for non-normal response distributions and non-linear relationship between predictors and responses. GAMs further extend GLMs by providing greater flexibility to the use of smooth functions. These models have been and are widely adopted for their ability to handle complex and non-linear relationship in insurance data. However, as all models, both GLMs and GAMs have limitations. They require the specification of a response distribution, which may not always accurately capture the underlying data. Moreover, these models can be sensitive to outliers, which can lead to a biased estimates. So to address these issues, you can obviously specify and try several distributions and select the one that best fits the data, or you can apply penalized regression to address the issue of the outliers. And exactly those considerations about the model limits are, let's say, a perfect access to the next slide. So those considerations bring us to the quantile regression. That is an alternative approach that offers several advantages over traditional methods. It is not a new model. It was introduced in 1978. Quantile regression offers a versatile approach to modeling insurance risks, enabling refined risk selection by examining the relationship between variables across the entire distribution of claim outcomes. By analyzing multiple quantiles of the response variable, this technique can reveal patterns and associations that might be missed by traditional mean-based regression models. So regression models that are working only on the mean of the distribution. Instead of modeling the mean response as a function of the independent variables, quantile regression estimates conditional quantile functions, providing insights into the relationship between variables and different points in the distribution. It allows for a more comprehensive understanding of how predictors influence the entire distribution of the response variable. Quantile regression can be formulated as a linear programming problem, making it computationally efficient. We use techniques such as simplex method or the barrier methods to solve the optimization problem. So some of the advanced, let's say, some of the usefulness of the quantile regression are, the possibility of observing the evolution, the variation, and identifying key drivers. So quantile regression analysis and relative results enable a comprehensive understanding of the risk factor dynamics. So it highlights variation between them and reveals the key drivers behind high-cost claims and ultimately guiding informed strategic decision. We can observe the evolution of the risk factors and the impact of the risk factors across the entire frequency and claim distribution. We can assess the extent of the variation between risk factors between different quantiles. And finally, we can identify what are the key risk factors that are driving high cost claims, for example, by analyzing higher quantile, higher than the mean. So finally, what are the main pro of this technique? For sure, there is, let's say, among the most interesting, there is the robustness to outliers. So unlike GLMs and GAMs, the quantile regression is less sensitive to outliers. So this is particularly important in insurance data where extreme observation can have a significant impact on model estimates. Then there is the aspect of the quantile regression being a distribution-free approach. So the quantile regression does not require the specification of a response distribution, making it more flexible and adaptable to a variety of data structures. The tail risk analysis. So quantile regression allows for a deeper understanding of tail risk, which is really crucial for solvency and capital management in the insurance industry. By modeling different quantiles, we can identify drivers of large losses and develop more effective risk mitigation strategies. Then there is the quantile premium principle. This is really pivotal in the rate making tariff process. So this principle emphasizes that the premium should not only cover the expected loss, but also provide a risk margin for adverse deviations. Quantile regression can help estimate the appropriate risk margin by analyzing the upper quantiles of the loss distribution, leading to a more accurate and fair premiums for policyholders, not just applying the usual flat loadings. And finally, but not less important, product design and underwriting. So how the quantile regression can help in designing new products and defining new underwriting rules. So it can inform the development of tailored insurance products and underwriting guidelines that target specific risk segments, reducing the potential for adverse selection. By offering differentiated products with the varying coverage levels, deductibles, and premiums, insurers can better attract and retain balanced risk pools, for sure. And those are only some of the advantages of this technique. Thank you.
Thank you, Claudio. Thank you for guiding us through this innovative technique of getting better market share against the competition. Another important technique is the optimization technique. Embracing advanced optimization techniques allows insurers in order to overcome the limitation of traditional methods, but also achieve better results. Optimization is pivotal whenever we think about different areas, but I would like to highlight several reasons. And the first one, it actually is helping you in order to determine the best optimal premium for each policyholder, but also is helping you in order to act against the balance, achieving the profitability while addressing social sensitive issues. Performing this technique, you always have to take in consideration several points, right? If we look on the advantages, the first one, it's actually the improve of pricing accuracy. By this, you're gonna reflect the true risk profile for each policyholder. The next one is the enhanced segmentation, where you identify the profitable and unprofitable segments for more accuracy. And if we think about the customer retention, the tailored pricing will help you in order to reduce the policyholder churns. When we think about embracing the social awareness, think about avoiding price walking by having a transparent pricing changes that will not penalize the long-term customers. Also, think about protecting vulnerable groups, applying regulatory guidelines and discounts in order to assure this. And last but not least, think about fairness in the rating factors by using only permitted rating factors, avoiding discrimination. Last but not least, if we look on ensuring compliance and social responsibility, we have to adhere to the regulation. We have to strictly follow the regulatory guidelines and act upon them. We need to collaborate within the stakeholders. We have to engage with the customers, with the regulators, with the industry bodies in order to create a fair pricing framework. And on top of that, we have to ongoing monitor all of that in order to assess the pricing practices to assure the compliancy and also the social responsibility. If we move to the next slide, I would like actually to talk a bit about the process, optimization process. When we think about pricing models, those pricing models should factor in three critical elements: the pricing strategy, the value of the product, both for the buyer but also for the seller, and as well the tactics in order to manage all of that. All the optimization problems, they have several components: the objective function, the decision variables, and the constraints. Whenever we think about an optimization problem, we are actually translating the real world problem into a mathematical equation. So now, looking on the objective function definition, this will help you in order to quantify the goal of the optimization process. This will help you also to balance competing priorities, such as minimizing the cost or maximizing the profits. And this will incorporate also the key performance metrics and the stakeholder interests. By having the constraints definition, you're going to define the boundaries of the decision variables, and you're going to reflect all the regulatory requirements, but also the business limitations. At the end, the optimization routine is executed, and then you can explore the results in order to continuously evaluate the optimization outcomes within the business objectives, and also monitor, refine, and adapt the model for an optimal performance and responsiveness to emerging trends. These two techniques, the distribution-free approach and the pricing optimization, will allow insurers in order to increase the competitivity and also to increase the profitability and the market share. We think that these elements are actually helping the insurers in order to get better results within the market and to assure the next, let's put it that way, customer segments that they will try to achieve, but also the customer segments that they will try to retain to assure better profitability. By having said that, I would like to thank you, and I would like to hand it over to the next session. Thank you.